thank all of you for attending today and taking your valuable time. The market has last year had a very good year, and the year before had a very good year, and so far we're off to a little rocky start, but we will talk about that and discuss that. There's been a lot of volatility. There's been some inflation talk. We've all heard about Jay Powell and interest rates. What is the Fed going to do? Are they going to raise it twice, 3 times, 4 times? I think if you listen to Jamie Dimon, he even said he thinks there's going to be 6 raises. So right now, I don't know if anybody's sure. But I also want to introduce our speaker that I've known for many, many years, and he's done a few of these Zooms with us over the past 2 years. Matt Potter. Matt Potter is with SEI. Matt is a CFA, which is a certified financial analyst. He works in the portfolio section at SEI. Prior to that, Matt's been at SEI a long time. I'll let you tell him how long. But prior to that, Matt was actually a small cap manager. So he worked with a firm, I think it was in New York, and was a manager of small cap fund. So he now is an analyst, but prior to his joining SEI many years ago, Matt actually was on that crazy Wall Street floor and deciding what stocks that he was going to buy. So Matt, if you want to say hello and give us a little more about yourself, we appreciate that. So Matt Potter,
Yes.
everybody.
Yes, and thanks for having me on and everyone for joining today. Yeah, I mean, I've been in the industry a little over 25 years, although certainly the last couple of years seem like longer. You know, it sort of feels like dog years sometimes. Yeah, spent a lot of time working with a few different portfolio management teams, and I've been with SEI since 2013. So that's gone really well, and every year is interesting, and every year gives you something different to talk about. So yeah, looking forward to our conversation today.
Well, great, Matt. You know, everybody is concerned. Obviously, we'll talk about the number one issue. Well, there's 2 number one issues, but let's talk about just this week alone. I believe Monday through Thursday, Monday, Tuesday, Wednesday, Thursday of this week, I think, you know, a couple of the indexes might have been down as much as 7%. Lots and lots and lots of volatility in the market. I had sent out an email, I think it was on Wednesday, talking about the last 20 years in volatility. Is this volatility normal, Matt, or is it something that we should be worried about? What are your thoughts on the volatility we are seeing today?
We would view it as normal, or at least common, certainly not pleasant or enjoyable. But I think it is important to understand that, you know, when markets do have these kinds of declines, first of all, they do happen with some regularity, probably more frequently than people may think. And they don't necessarily mean that there's an economic crisis. And in some ways, they're actually healthy. I mean, markets can get ahead of themselves. They can sell off and become too cheap. And so part of what's happening, that's, I think, why they're called corrections, they're kind of corrective episodes. Just to give a sense of the long-term history, if you look at the Standard & Poor's 500 index, on average, that index typically will have a 10% peak to trough decline about once a year. And it has had 5% dips about 3.5 times a year. So, you know, these kinds of declines certainly do happen on a somewhat regular basis. And they don't necessarily mean that, you know, there's a longer term, bigger structural issue or a recession on the horizon. Often they just are happening for more shorter term reasons and, you know, are, you know, relatively short-lived.
You know, the letter we sent out, or I sent out the other day, I believe since 2020, 11 of the last 20 years, the market has seen 10% intra-year dips and swings just over that time. So 55% of the time we've seen those intra-year dips. So it is kind of normal. However, some people may be concerned now with inflation. Is that a concern? Because when you get the volatility connected to this inflation that we see right now, what is there even more concern? Are there more things to worry about? You know, it seemed like some of the companies reporting over the past few days have had some very, very good results. There haven't been the real companies, I call them, the companies that really have products and sell things. They've reported some good earnings and some good revenue. What happens now with this volatility combined with some pretty high inflation that we have at the moment?
Yeah. So I think in some ways, what we've been seeing recently has been maybe a little bit of a return to normal. Because when you think about it, you look back over the last 3 years, they were pretty unusual. We had 3 straight years of the S&P 500 gaining more than 18%. And that included 2020 when, we had the pandemic strike and we had a massive quick decline and then quick recovery. One of the things we haven't really seen as much of until more recently has been inflation. And it's interesting because during 2020, we were talking earlier, there was kind of a big fall off in demand as people sort of didn't know what to make of the coronavirus. They were working from home. Aspects of the economy were basically shutting down. And so a lot of producers of goods, producers of energy components, things like that, really kind of pulled back because they thought that the demand would just, completely dry up. And in some ways it did. And then when it came back, it really came roaring back. And the thing is, when you have sort of supply cut down and then demand kind of comes back quickly, you can't necessarily flip a switch and bring everything back online. So some of what we've seen has been just sort of an economy dealing with very high levels of demand. Consumers have a lot of cash to spend. They certainly got a lot of support over the last couple of years, whether it's unemployment benefits or other forms of stimulus that have gone into the economy. And, if you can't, go out to a restaurant or fly somewhere or take a cruise, you're probably going to, be buying stuff. And so, a lot of people have bought a lot of things, and there have been supply chain issues and shortages. Even things like autos have been, manufacturers have had issues with not having enough semiconductors. And certainly getting things made often in other countries such as Asia, they may have been slowed down by, outbreaks of the pandemic. Getting things actually shipped across the Pacific, we've all seen the reports of the backlogs at the ports of Long Beach and Los Angeles. And then even just getting items from those ports to their final destination, there's been a lack of truck drivers to do that. So, in many ways, the supply chain, I think some of the weaknesses in the supply chain got exposed more recently. And again, when you've had continued demand and much less supply, that typically means higher prices. So that's been kind of a part of what's been going on. And frankly, we've had very little inflation probably since the global financial crisis. And in some ways, the Federal Reserve had been trying to engineer a bit more inflation to kind of bring it back up to their target rates. And then more recently, obviously, it went up a fair amount. We don't think we're going back to the 1970s or early 1980s when rates were incredibly high. But some elements of inflation, they will take some time to work through. And other things like labor costs may be a little bit more persistent. So, it represents a change. It's something that I think markets have just sort of had to adjust to. And that may be part of what we're seeing now is kind of a transition from a period of, a lot of stimulus from the Federal Reserve and from Congress, a period of low inflation, to a period of, less monetary and fiscal stimulus and higher inflation and the Federal Reserve starting to raise interest rates or talking about starting to raise interest rates, all of that kind of, I think, comes into the mix, not to mention the geopolitical situation with Ukraine. I think there are just a lot of issues that are on investors' minds right now, all kind of at the same time.
Yeah, that's been another one that was added just this week. We had inflation, market volatility, interest rates, and now the geopolitical issue with Ukraine. So we've kind of gotten touched on the perfect storm, I guess, from every possible corner that we could get has really created a lot of uncertainty. And that Matt, correct, is one of the most important pieces that the market absolutely hates is uncertainty. And when they have a lot of uncertainty in the market, volatility just continues to rise. And I want to quickly talk about it. I've talked to some of the clients about it, but not everyone. The Bureau of Economics, I believe I saw a report, actually it was about a year ago, during 2020, as Matt touched a few minutes ago, people weren't going on cruises, they weren't going on vacations, they weren't in hotels. I think airlines were way down. Well, we know airlines were way down on the number of flights they were having. Restaurants were closed. People did not have a lot of money to spend. There's just, I don't know, how much clothes can you buy on Amazon? And there was a lot of stimulus, unemployment money that had come in. And a report that I had read, again, the source on that was, I believe, Bureau of Economics, federal government. The US typically, consumers in their checking accounts, money markets, and CDs typically have about $1.6 trillion in cash. In January of last year, January of 2021, going into 2021, there was about $6 trillion in cash. So normal was about 1.6. This was up to about $6 trillion. And as more people were vaccinated and things opened up and people were able to get out of their house and they could take vacations and spend money, go to restaurants, trillions of dollars hit the market. And as Matt said, there were some cutbacks in 2020, and all of a sudden, all this money was flooded in and people were just buying whatever they could just to get out of their house and be happy. So it really, really hit hard all the way around. Matt, we're talking about interest rates and the Fed. What do you think the effect will be? And, you know, Jay Powell had a press conference, I believe, just recently. What were your thoughts on what he brought up at the press conference regarding the Fed and what they may or may not do over the next year, 2022?
Yeah. It was interesting in that he mentioned a number of times the strength of the U.S. economy and particularly the strength of labor markets. And that's something that the Fed kind of looks at their dual mandate to keep inflation at reasonable levels and also to support employment. It seems like, just from what he was saying, that they think that employment is in good shape right now. So maybe that's why they're shifting kind of more of their focus to the inflationary side. It also sounded like, while they have begun to talk about what their plan is going to be, they also don't, it doesn't sound like they have it completely set in stone. I'm not sure they know exactly how many rate hikes they're going to have this year. The first one, it certainly could come as early as March, but I think this is a Fed that's going to be a bit more data dependent. If things do change, I think they are, and he did talk about being nimble. They do have the flexibility to either accelerate things or slow things down in terms of what they can do. There's the aspect where they were putting a lot of stimulus into the economy by buying treasury bonds, buying mortgage bonds in the open market. They've pulled back from that. So that's the taper, if people have heard reference to that. And then at some point, they're going to reduce the size of their balance sheet, but probably gradually. And then there's also raising of interest rates, which again, it sounds like that's something that they're going to be potentially starting in March. But again, it didn't sound like they necessarily knew exactly what the time frame would look like for everything. So I think they may still be working out some of the details. I'm sure they have ideas of how they think things are going to go, but it sounds like they're not being overly dogmatic about it. They do still want to, because there is a lag with when policy gets changed. And so I think they do want to track, see how things are going, and make any adjustments if necessary. So, while markets seem to be pricing in, something in the order of maybe, 4 or 5 rate hikes this year, that may or may not happen. I think it's just going to depend on what kind of incoming data they see and how they react to it.
And the 10-year Treasury has reacted over the last 6 months or so on the possibility of a Fed hike. We were down, I believe, in November or and actually in late August, according to Yahoo Finance. The 10-year Treasury was about 1.17%. And as of today, again, looking up on Yahoo Finance, it's around 1.77 to 1.8. Now, that may not seem like much to many people, but percentage-wise, that 0.6% increase is a significant increase. And that may slow down some of the housing market that has absolutely been on fire. I heard, I guess, National Board of Realtors announced yesterday, and again, they're going to adjust the numbers because it seems like whenever numbers are put out, a couple of months later, they come back with some type of adjustment. But I believe they said in November, housing was up, or prices were up about 18%. In December, they were up only 3%. So we'll see what adjustments come out, but that is a significant difference in slowdown. And possibly it may have been the 30-year fixed interest rates have gone up since November, possibly somewhere around 0.8 to 1%, depending on the region, and many factors are out there. So rates being still an all-time low, or one of the low ones at 3.6% for 30-year fixed rate, according to bankrate.com. Those are extremely low. However, pricing on houses have gotten so high that it could make a big difference in a monthly payment, just that 1%. So that may help slow inflation a little, maybe get a little more inventory back on the market for the realtors and get back to some normal housing market, which is a big factor on inflation as well. We've talked about the chips. Right now, the Taiwan Semiconductor is building a massive plant across from Intel outside of Phoenix. And just a few days ago, Intel announced that they are now building another plant in Ohio, and I think Columbus, but in the state of Ohio. And that has been our biggest issue, as you talked earlier, is the chips. And it's great to see that they are building 2 big chip plants in the U.S. So we won't have to rely on, overseas issues. We'll have more control on it here in the U.S. And it's more U.S. jobs, but they need to, it's good to see that they're getting these plants started, up and running. But we're still going to be probably 18 months away. But demand may slow down a little as all of that free cash that's been sitting out there being spent like crazy, that may help as well. Finally, Matt, what I wanted to talk about, clients ask me, and I've talked about, well, where should we put our money? What sectors? What should we do? Over the last year, we work with managed volatility, which, as has a low beta, and everybody by now knows low beta is low volatility. But they seem to have always had a value tilt, and we've been in that market for a while, and we continue to like the managed volatility sector. We give up a little on the upside, but we also don't usually have as much risk on the downside. And we've also been leaning now towards value over the last year. We've been adding to value. What have you and SEI been looking at as far as areas are sectors that you feel are stronger to invest in, or during these volatile times, rising interest rates, everything we're talking about, what have your team been talking about areas to look at as well?
Yeah. Sure. Well, one thing we are big believers in diversification, so our portfolios, will tend to have pretty broad exposure. But by and large, I think we do see this as a favorable environment for value stocks. We've had a period where growth stocks, companies with high or a kind of above market expected growth have done very well. Those have typically been names like technology or other similar stocks like that. And a few of these companies represent a big part of many of the indices that are tracked. So we've had a period, multi-year period of growth kind of really leading the way, especially technology. That started to reverse a bit last year. We actually, energy was the best performing sector in the S&P 500. And then real estate, you had mentioned, housing prices was also strong. And then financials and technology were also similarly strong. So it was a little bit more of a mixed bag last year. And we wouldn't be surprised if looking forward, some of the more value sectors and not necessarily even sectors, but also less expensive stocks. So stocks trading at a lower multiple relative to their future earnings might be more favored. Again, there's kind of a bigger spread in sort of how cheap and expensive value stocks are relative to their history and relative to growth stocks. Also, value as an area tends to do pretty well coming out of a recession. And when interest rates rise, when inflation rises, that tends to hurt expensive stocks more. Interestingly, that also could have implications for US stocks versus non-US. International stocks, by and large, tend to be less technology focused. You look at the indices, they tend to have more in cyclical areas, financials, materials, industrials, and less in technology than the US indexes. So it wouldn't surprise us if there were this kind of rotation away from the really big growth stocks into less expensive names, if that also kind of turned into a tailwind for some developed international economies and markets as well. So those are some of the areas where we're looking at on the equity side. But yeah, I would say certainly we think it's important to be diversified. Trends usually don't go in a straight line. Even last year, value did really well for about the first 4.5 months. And then, when the Delta variant sort of took over, we started to see growth do better than value. And both of them finished up, but growth finished up a little bit higher than value. So we kind of saw shifting trends, and we may see some of that going forward. But we do see value is looking favorable right now, just kind of based on some of those factors I talked about.
And historically, value stocks usually have a better dividend than growth stocks. Growth are just, they're out there for that capital appreciation, and the value stocks have tended to also have a nice dividend pay with them, and that can help in this time period as well. I think also you talked about international, the developed, which we are looking at. And I believe that the international is slightly ahead of us. Seemed like they got hit a little earlier with the Omicron virus, and they're starting to get rid of it quicker over there now because they were a little ahead of us. So they may have a little head start on us as well. So we will continue to monitor that sector. We have a couple of managers we've been working with now that are they were high quality global growth managers, but they do have that international global exposure. So that is really what we're looking at. We're looking at a little tilt more towards growth, absolutely not giving up towards value, absolutely not giving up on growth. But that's why some clients want to know, why do we have 7 or 8 different managers? Because we cover all the sectors. We're covering the large cap growth, the mid cap, the small cap growth. We want to cover some of the value. We want to cover some of the managed volatility areas, because we saw it and we continue to see it. At any moment, one sector of the market can switch off and the other one can switch on. So really, diversification has proven to be a very, very good way to go, because we don't like to take bets on one sector. You know, we saw what's just happened with all those big FANG stocks. They were on fire, and we saw what's happened to those stocks in that area over the last 3 or 4 weeks, and it hasn't been pretty. So that's why we do diversify. So really, Matt, I know we wanted to try to keep it to a half hour. We're just about there. To wrap it up, we're looking, you know, continuing to see a little tilt like we have been doing towards that value. Take a look at possibly some more international. We know this market volatility has been normal, and we have seen volatility 20 of the last 20 years. 11 of those years, we have seen 10% or more drops intra-year, meaning throughout the year, we've seen the drops like that. We're going to continue to see what Jay Powell is doing, because he probably still doesn't know what he's going to do. He's supposedly going to make some raises, and we believe he will. Will it be 2, 3, 4, 5, or Jamie Dimon 6 or 7? Nobody really knows, and we don't think even the Fed knows right now. And volatility is normal. We will watch it and continue to try to do a proper asset allocation for the clients like we have been doing. It has been working for many years now, and we want to continue that. So with that, if you have any questions going forward, please email me or Kelly, and I'll get the message, because we are here for you. We would like to answer your questions, but we would like to do it on an individual basis, because everybody here has custom portfolios. We are not a firm that just has, here's one model, and everybody does not fit into that same model. You know, we're like those custom tailors. You're not buying that suit off the rack. Everything is custom made for you. Your portfolios are custom designed for each and every individual client that I have. So we want to answer your specific questions based on your needs and your risk tolerance and where you need to be. So with that, I would like to thank everybody, first for your business, second for taking time to come out on this call today. And I encourage you to please, if you have any questions, call me, email me, and I will answer specific questions based on what your needs and risk tolerances and what you need. So with that, thank you again to Matt for taking time away from your day, and SEI letting you out of that office for a half hour while the markets are a little crazy right now. But I appreciate that and everything else that's been done. With that, thanks to everybody, and have a great day. And I look forward to speaking with you in the future. And I think Matt's smiling. We'll have him on again in the near future again. So he's been on a few times. We appreciate it. So thank you, Matt, for everything you do for us.
My pleasure.
Have a good day, everybody. Bye-bye.
Take care, everyone.
Okay.